This is the Best Stocks to Buy podcast. We use our proprietary algorithms to screen, analyze, and rank over 6,000 stocks every week. This podcast is made possible by Connor Management Group, a registered investment advisor firm. If you've been enjoying these podcasts, we're sure you'll like our Saturday morning newsletter just as much, if not more. It is informative but light and includes personally curated articles on investing, money, and just plain leisure fun that we think you would enjoy. Just visit our website at www.connormg.com and click on newsletter to subscribe. All right, on to our presentation. Hello everyone, this is Mathis Connor with Connor Management Group, and this week we're going to look at the best overvalued stock to sell right now. Today is Tuesday, June 16th, 2015. And here on the opening slide, we see that this company is in the drug stores industry, and we see its 6-month downside potential at negative 36.8%. Going on to the next slide, we see that the name of this company is called Rite Aid Corporation. The ticker symbol is RAD. Once again, this company is in the drug store industry, and we see its 6-month downside potential at negative 36.8%. Going on to the quick facts slide, here's a business summary description for Rite Aid. Rite Aid Corporation is one of the nation's largest drugstore retail chains with 4,570 stores in operation in 31 states. The company sells prescription drugs and a range of other merchandise, including over-the-counter medications, health and beauty aids, personal care items, cosmetics, household items, food and beverage, greeting cards, seasonal merchandise, and other everyday and convenience products. Their website is www.riteaid, that's RITEAID.com. The company is headquartered in Camp Hill, Pennsylvania. They were founded in 1927, and right now they have 50,730 employees. Onto the products and services slide. What we have here is the Rite Aid logo. We have a photo of a Rite Aid convenience and drug store, and we also have a photo of their national footprint. What you'll see is that Rite Aid has stores in almost every state east of the Mississippi River, with the exception of Florida, and they also have a bunch of states on the stores on the West Coast. Additionally, on this slide, we have some excerpts from one of their latest investor presentations. One talking about the store renovations that they're making across the country. They've been doing that for the past 3 or 4 years, and they're continuing to do it throughout 2015. Additionally, there's a slide here that's talking about an upcoming acquisition that the company is pursuing. The company is trying to accomplish a merger with a company called Envision RX. And Envision RX is what's known as a pharmacy benefits manager, and they're basically trying to acquire this company to expand their customer base. A pharmacy benefits manager is an administrative company that buys prescription drugs from pharmacies and other drug manufacturers for the benefit of insurance companies and other corporations. So Rite Aid is basically trying to move into their vertical to bring them additional customers. This is a pending acquisition, and time will tell to see if it will go through. These are the main activities, what's going on with Rite Aid right now, these store renovations, this pending acquisition. While these things may appear to be positive, in our view, it's somewhat of a drag right now, and we and other analysts believe that this will create a drag on earnings, which is the reason for our negative outlook. On to the metrics slide. The annual revenue for Rite Aid over the last 12 months was $26.5 billion. They are a sizable company. The net income over the last 12 months was $2.1 billion, and the cash from operations was $649 million. The operating margins for Rite Aid in 2014, they were 4.7%, and for 2015, they're tracking to be 4.5%. So this is not a heavy, thick, large margin business. Onto valuation metrics. The trailing PE ratio for Rite Aid right now stands at 22.4, and the forward PE ratio right now stands for 35.0. And that means analysts expect earnings to decline significantly over the next 12 months. And Rite Aid's earnings are expected to come down a bit as a result of two drivers. Basically, an increase in generic drugs, which at the end of the day affects their margins, and also a reduction in reimbursement margins. Rite Aid from 2013 to 2014 had a rather large increase in earnings per share for the year, and that increase is expected to reverse in the opposite direction because of the increase in generics and the reduction in reimbursement rates for a lot of different drugs. So we see the company as facing some headwinds. They are trying to counter those headwinds, but we think it's going to take at least 1 to 2 years before they make a turnaround if they are indeed successful at it. Back to the valuation metrics. The PEG ratio for Rite Aid stands at 0.9. Usually anything at 1 or less is considered a valued opportunity. The price to sales ratio is at 0.3, also pretty low. And the price to book ratio is pretty meaningless. I won't even bother to report it. And the enterprise value to EBITDA ratio stands at 11.4. The dividend yield for Rite Aid is 0 right now. They do not pay any dividends. And so consequently, the average dividend payout ratio is also 0. Onto the price chart. Over the last 12 months, Rite Aid has increased in price 22%. It wasn't a smooth ride up. The stock's kind of gone up and down a bit. And despite this, we still have a negative outlook. We just see the company is facing headwinds, and management has confirmed that their earnings will pull back significantly from the prior 12 months. And additionally, it remains to be seen on whether they'll recognize all the efficiencies of this pending merger. On to the next slide. The why now, the Bear Rationale. Our reasons for our negative outlook for Rite Aid are basically increasing expenses. And additionally, part of that increasing expenses is a projected decrease in cash flow per share. Additionally, the company is revamping its stores across the nation, so it is increasing capital expenditures. Additionally, the company is issuing new shares. So as a shareholder, the value you receive per share declines when new shares are issued, usually, not always. And additionally, the valuation metrics appear to be high in the near future. So for those reasons are why we have a negative outlook. Basically, increasing expenses, declining cash flow per share, increasing capital expenditures, shares being issued, and high valuation metrics. And onto the summary slide. The financial statement quality of Rite Aid we consider as poor. The company has over $5 billion in debt. And for instance, their net profit for 2014 was just under $400 million. And for 2015, it's expected to be around $250 million. So $400 million, $250 million against $5 billion. That's a highly levered company. The price pattern trend, as we mentioned, the stock has gone up over the last 12 months. Our market outlook is somewhat negative. We're just seeing more overvalued names than undervalued names. So that may create headwinds for companies that going up in general. So the recent closing price for Rite Aid is $8.75, and our 6-month price target for the company is $5.53. So that gives Rite Aid an outlook, a 6-month downside potential of negative 36.8%. All these reasons that we believe that Rite Aid is the best overvalued stock to sell right now. We hope you found this presentation helpful, and we'll talk to you again next week. Take care. Bye. Just to close, remember that Connor Management Group is a registered investment advisor. In addition to being a source of quality stock investment reviews, we are money managers, not financial planners. Our sole goal is to grow our clients' savings and retirement accounts in a personalized manner as quickly as possible using one or more of our strategies. We can manage all or just part of your IRA account as well as a regular taxable account. Just visit us at www.connormg.com to review our service, or just give us a call at 281-947-2201. Have a great week.